Thanks, Adam, and thanks everybody for having me today. Tim Goff was meant to present for ASIC, but Tim's in Canberra, and as somebody who grew up in Canberra and moved to Sydney, I can assure you I've got the better deal. So in terms of my presentation today, I'll give you a quick overview of ASIC's vision and priorities for the year ahead, and also the work that the team that I am in, the credit and banking team, is doing. There are then three specific initiatives that I'll talk to in a little bit more detail that I think might be relevant to those of you in the room, and then I'll close with some general remarks about enforcement and risks. So in terms of ASIC's priorities, for the year ahead, they're listed there on the slide. As part of our annual business planning process now, we sort of work through the key issues that we see in the sectors that we're responsible for and try to draw out what we're really going to focus on across the various functions and teams that we have. As you'll see there, those 7 priorities that we've set for the year ahead, they're meant to support our vision of a fair, strong and efficient financial system for all Australians. The other sort of general observation I'd make is that although the Royal Commission is mentioned in one of those 7, the issues and themes and misconduct that were sort of brought to light during the Royal Commission really do permeate all 7. I suppose to make that a little bit more real, what those priorities mean in the credit, retail banking and payment space, some of the key pieces of work that are going on underway that are sort of areas of focus for us at the moment include updating our guidance on responsible lending, a review of car finance and car finance responsible lending practices, some more work on lender responses to consumers that are experiencing financial difficulty, a review that we've had underway for some time now on loan application fraud, and a review of the Epayments code that I'll talk about in more detail shortly. That's really just the tip of the iceberg though. In addition to those streams of work, there's also things we're doing underway on credit cards, reverse mortgages, buy now, pay later arrangements, unfair contract terms in small business lending contracts, as well as our sort of typical business as usual work. And in addition to all of that, we're committed to assisting with the implementation of the law reforms that are flowing from the Royal Commission, and in this space that means things like the best interest duty and remuneration changes for the mortgage broking industry and removal of the point of sale exemption. I might talk a little bit about the new approaches that you will be seeing from ASIC in our work. I suppose first off, there's the greater focus on transparency, and sometimes that's referred to as the antiseptic of sunlight, but sort of being more open and about what we find and what we're doing. And a good example of that is the public hearings that we recently held in relation to our responsible lending review and our update of RG 209. And that provided an opportunity for lenders and consumer advocates to air their views on the current guidance, our proposed updates and adjustments and any issues, and to do so in a public forum. In addition, sort of another key approach that sort of is mentioned in a couple of spots on the slide is the increased use of data. So first off, in the consumer context, we're conducting more sort of longitudinal consumer research to track and evaluate attitudes, behaviours and the financial situations of consumers across a range of financial services and products. And the purpose of doing this is to try and move away from potentially sort of bespoke one-off pieces of research, but to sort of gather more information across time to better allow us to better target our work. And there's some synergies there with what we're doing in terms of the data collection from industry as well. As you may be aware, we have conducted a pilot of recurrent data collection in the home loans context, and there's certainly potential for other recurrent data sets as well, whether that's, say, around credit cards or personal loans or other products. Deborah mentioned that she wasn't going to talk about this, but in terms of new approaches, there's our close and continuous monitoring team, which has regular on-site presence at some of Australia's largest financial institutions. That's and very much a new approach for ASIC, as well as the product intervention powers that I'll talk about now. We welcome the passage of the legislation that introduced these powers earlier this year, and these powers allow ASIC to temporarily intervene in a range of ways, potentially including product bannings, where we see a risk of significant consumer detriment. In terms of our approach to using the product intervention power, it's not meant as a last resort. It allows us to respond in a flexible, targeted, effective, and importantly, timely way. It's not reliant on a breach of the laws. The focus of the power and the way in which we intend to use it is to reduce significant consumer detriment. And it means that we can take action before consumers suffer that detriment and better uphold the community's expectations regarding the conduct of issuers and distributors. Importantly, we will not be using the product intervention power as a pre-approval of products or to eliminate monetary loss or all risk from the system. In July, we consulted on the first proposed use of our product intervention power in relation to a short-term credit provider and its associate. That use of the power is currently subject to judicial review before the Federal Court in New South Wales. And since that time, we've consulted on using our product intervention powers in other contexts as well. At the same time that ASIC was granted a product intervention power, the legislation also put in place design and distribution obligations, which commence in 2021. And these obligations provide for accountability for issuers and distributors to design, market, and distribute financial and credit products that meet consumer needs. Issuers must identify in advance who their product is right for and direct distribution to those target markets. These are a real step change in terms of the regulation of financial services and credit products, and as it goes beyond disclosure. We'll be publishing some guidance on these new requirements in draft form before the end of the year. But given the significance of these obligations, we encourage everybody to start thinking now about what they need to do in order to comply. 2021 will come along very quickly. I'll now talk to three specific initiatives that ASIC has undertaken over the last 12 months. The first thing I want to talk about is machine learning and digitally assisted compliance. Earlier this year, we showcased a series of demonstrations showing how technology can be used in analysing and monitoring advertisement and financial promotion material in both traditional and non-traditional formats. And to give you some context for this, in 2010, we were granted expanded jurisdiction to deal with misleading and false representations. And the way that we dealt with that at the time is that we set up a proactive advertising monitoring team that had 8 staff monitoring over 200 ads a week on a rotating basis. So 10,000 advertisements over a 12-month period, and that was still a drop in the ocean. And we wanted to test whether machine learning would allow us to do this job quicker and with less resources. So in terms of what we did, we provided demonstrators with a set of 180 examples of promotional material, which related to credit, banking, and insurance products. And they varied in format, so some banners, billboards, print, TV, and radio ads. And we provided an explanation of the rules or risk factors that we were keen to identify, referenced those against some of the applicable legislative requirements and ASIC guidance. We also provided real case study examples and some annotated examples to illustrate these concepts, especially as many of the requirements are principles-based and therefore there's a fair degree of subjectivity around some of the issues that can occur. In terms of what we found that there is technology in the market to analyse financial promotions material against regulatory requirements. We observed varying degrees of sophistication in that material. So, for instance, some providers could convert voice and images to text, whereas others couldn't. And some providers could even leverage off third-party data sets, so say the ASIC registers in terms of licensees and representatives. The technology does face some challenges. The first example is around data quality, for instance, where poor quality image or text that's not very clear can sort of affect the ability of the tool to analyse the advertisement. The second were the large volumes of data that were needed to get the machine learning to operate effectively. However, overall, there was a consensus that the technology is meant to improve efficiency by freeing up human resources so that humans can tackle the more subjective issues and as they're flagged using technology. However, humans still have an important role to play. In summing up, this is technology that can be put to use by financial firms and their providers in-house to enhance their own regulatory compliance. And mature risk management means proactive identification of these issues. The second workstream I want to talk about is voice analytics. In 2018, ASIC reviewed the sales practices of 11 firms that were selling life insurance through direct telephone sales. And as part of that review, ASIC staff listened to over 500 call recordings to look for poor conduct, including inadequate disclosure, inappropriate pressure selling tactics, and other tactics used to reduce informed decision-making. Following on from that review, we engaged 3 vendors to test the effectiveness of voice analytics and voice-to-text software in regulatory compliance. We wanted to understand how we, or industry, might review more calls in a shorter time frame by analysing, flagging, and reporting on calls that contain inappropriate sales tactics. Throughout the procurement process, we worked with 3 successful vendors who were provided with more than 1,700 calls that had been analysed by humans and then asked to feed them through their own systems for analysis. What our trial found was that there is potential for the technology, although we found that it was better at detecting some kinds of misconduct than others. The technology at the moment is really quite dependent on the quality of call recording, which can be influenced by both technical and environmental factors. For example, mono audio call recording can mean that machines can't identify who is speaking. So in that area, we would recommend that industry consider working with call centre providers and technology firms in relation to the best practice standards in call recording. We can see an increased use for this technology in our regulatory work, both in credit and insurance, although the capacity is somewhat limited where we're looking at legacy calls. The final workstream that I'll talk to is our review of the Epayments code. For those of you who aren't aware, the Epayments code is a voluntary code that ASIC administers. Most of the large banks in Australia subscribe to the code. And it plays an important role in the regulation of electronic payment facilities in Australia. It complements other regulatory requirements such as the need to hold either a credit or financial services licence or both from ASIC, advice, training and disclosure obligations that sit in the law as well. So we're currently reviewing the Epayments code with a key aim being to ensure that the code continues to work effectively in an environment of constant and rapid change, both in terms of technology, but also consumers' behaviour and interactions with providers. So earlier this year, we issued a consultation paper to ask for submissions about the scope of our review of the code. And this will be followed in due course by another consultation paper to propose amendments to the code. And some of the key issues that we're considering that the code may need to reflect include new ways of account access and payment authorisations, such as biometrics as distinct from passcodes and PINs, the increasing use by consumers and providers of account aggregation services, which employ screen scraping technology, including in personal financial management, but also tools to support credit decisioning. Increasing use of consumer-owned mobile devices like smartphones to make payments instead of physical facilities that are provided by the code subscriber. And finally, the new payments platform, and that's relevant because some of the requirements in the ePayments code around mistaken payments go specifically to other clearing systems. Some issues relating to the code give rise to a diverse range of stakeholder views, and this presents challenges for us in working out how the code should apply to certain issues. We're therefore taking the time we need to carefully consider all the feedback that we've received before deciding on a position and going out to industry and other stakeholders again with some proposals. So our review at this stage is going to continue into the first half of 2020. I'll now just, to conclude, touch on enforcement. As you would have heard from ASIC, we're committed to court-based enforcement to pursue deterrence with visible public denunciation and penalties for misconduct. In terms of our enforcement strategy, the why not litigate approach that we're taking is, has been made known, but more broadly, we'll be seeking to focus on taking action to protect consumers, using the new penalties that recently passed Parliament, using previously untested legislative provisions to clarify the law, and addressing mis-selling of products. Our enforcement strategy is a very important part of achieving our vision. However, enforcement is not the only thing that we do. I might also say something about the general conduct obligations of licensees, particularly around adequate risk management systems. An example of where these obligations are important are around the use of black box algorithms, which may improve efficiency but still need to comply with the law. To give you an example, during our review of payday lenders over the last few years, we observed lenders that were relying on algorithms to speed up the loan approval process, but where they had not ensured that the algorithms adequately accounted for the consumer's financial position. The result was that the lender had been unable to demonstrate that they complied with the law, and in some instances needed to provide refunds to their consumers. From our perspective, there's an important message in that automated processes are very tempting due to their ability to increase efficiency and potentially profitability. But they require supporting documentation to explain how they work, as well as regular monitoring and testing to ensure that they're being used in a way that complies with the law. One final point is that a trusted and efficient financial system requires that products perform correctly or as consumers expect. System errors that result in consumers being overcharged or not receiving a contracted benefit. In ASIC's eyes, these are not always going to be blameless occurrences. If you're providing a credit product or a financial product to consumers, then it really must do the things that you say that it does. Otherwise, you may fall afoul of the law that ASIC administers. Thanks very much for your time today. No worries at all.
Thank you very much. That was absolutely fascinating stuff, Richard. We're going to move a couple of chairs up here for you. And come and join us again, please, Deborah. Q&A time. The questions have been flooding in. This is a really cutting-edge, important area, so we're going to go with one of the best in the business tomorrow at this Q&A. You might know him as Cuscal's Chief Risk Officer, but you might not know that our featured closing guest this afternoon, Steve Waugh, former Australian cricket captain, knows him as a handy opening batsman and quite reasonable medium pace bowler for Petersham in the ding-dong battles of the early and mid-1980s. Don't worry, I'll be... that's what you said about yourself. We'll find out what Steve Waugh thought after 2:30 this afternoon. Please give Kieran McKenna a big round of applause. All yours, Kieran.
Talk about trust. Can you trust Adam Spencer? Thank you for that introduction and thank you for your presentations today. We've got a load of questions and some of them sort of play to each of your strengths, so I'll see how we go. The first one's around... and Deborah, and probably for both of you, has the pendulum swung too far? So if you think pre-Hayne, post-Hayne, everybody's now super focused on doing everything right, almost to the sort of extent that they're probably stifling innovation. So can we see the pendulum swinging back, or we think we're in a new norm for a little while? And I just remind you, Deborah, you're in front of a regulator.
I think I don't see it as a pendulum, first and foremost. We shouldn't be thinking that there was some kind of, swing of the pendulum some time ago that didn't require us to do the right thing, right? So we've always been required to do the right thing. I think it's just that we've had some very stark reminders of where we've failed to do that. So for a start, I wouldn't see it that way, and I think when I talked about the accountability spectrum, it's more nuanced than that. I actually see a lot of light at the end of this because there's a lot of good opportunity coming through, and other speakers this morning have spoken about that opportunity to, don't think about law and compliance, think about a broader, sense of good conduct and where the opportunity is for you to get that right. So I think that's probably my answer for that question.
Yeah, I'd agree with that, and I suppose what the things that are central to the regulators' minds, those 6 principles that Hayne identified, they really are, to the extent that there are breaches of the law, it's really the breaches of the law that go in hand with, a failure in some of those principles that are the ones that really concern us. And sort of separate to our work administering the law, we're also keen to promote and foster innovation, and so to try to get that balance just right. So I suppose if people feel that they have a new product or service and they're not really sure where it fits, or they're not really sure if it's permitted under the law or not, we'd encourage you to come and have a chat with us. We're always happy to reach out and have a discussion.
Thanks for that. Richard, you've got people excited about how you're using data, so I think there could be a business opportunity here. We've got a couple of people in the audience who said, how do we get access to those tools? So if we're the sort of player in the market and you're observing and monitoring, how can we make use of those tools in a collaborative sense? Or are you going to keep it in your own backyard and play the oversight role?
The sort of tools that I spoke about with around voice analytics and promotions, so those weren't ASIC developed tools. They were provided by third parties. So they are available in the market for you or any of your colleagues if that's of interest.
All right, so I might, and there's a sort of self-interest here, I might actually pose you a question offline and get that around to the audience about who they were and how you can actually
that should be
process
fine.
to go through. That'd be good. Deborah, and it's sort of akin to our earlier question, there's a question here that if it was a 2-horse race and one of the horses was self-interest, would you back it every time against regulation? And I think that the emphasis of the question is, does self-interest beat regulation, or is good regulation coming to help with self-interest?
I think it's I could say that recent history shows that the self-interest thoroughbred can come to a very undignified and reputationally damaging end. I think that it ought not to be seen as 2 horses. It is again more nuanced than that. If you just run self-interest, you're going to land yourself with more and more and more regulation. It's kind of up to you. And I think self-interest is changing. It's certainly been shown in the past that that's been dominant. But I think the notion of what self-interest is broadening. And if you think about a longer-term horizon, and your interest is aligned with your customers' interests, with your stakeholders' interests, and that includes, your stakeholders include your regulators, and there's a commonality of interest, I think that's probably the way to approach it for the future. But it's a very good question. I think the Royal Commission sort of taught us some lessons about self-interest.
Richard, next for you. And I noticed on your thematics up there you had buy now, pay later. The question, quite pointed, is can you please talk to us about the position on the lack of regulation in that space?
Sure. So as I suspect most people in the room are aware, buy now, pay later arrangements are typically not regulated under the same regime as other consumer credit products. They are subject to, the sort of general economy-wide rules around misleading and deceptive conduct and protections against unfair contract terms, but not the specific credit regime. That's something where we are doing some more work to explore what effect that really has. We put out a report late last year and we're planning another one for later in 2019-20, looking at the extent to which there's consumer harm associated with the different regulatory arrangements that apply to those products.
Deborah, for you, as a board or an entity, do they just need to super focus back on governance and ethics and conduct, or do you see some smarter approaches emerging? So, how's a board these days engaging better to sort of have that better oversight process?
I think the first thing for a board is to define the purpose and be really clear and have a shared understanding of what the organisational purpose is, because that's the DNA, it's the anchor. And then everything the board does in terms of supervising the entity comes back to that. People have talked this morning about, I've put it slightly differently, being on message. So what's our message? Are we on message? The board should be oversighting that we are, and knowing when we're not, when we go off message, and what's driving that, and help to remediate that so that we can, keep steering the ship and bringing it back on course. I think that's really important. And when I heard Helen Rowell from APRA speak, she came to Deloitte, this is a little while ago now, and we were debating this concept of community standards and expectations, which is the one that company directors feel quite uncomfortable about. And she actually said that the best thing that you can do to meet that standard is to make sure that you're on message and monitor that and look, oversight that. And to me, that's a conduct message. So that's sort of the conduct blind spot message that I was giving. That's a good way to monitor it. You don't have to have a dashboard with 568 million conduct indicators. You just need to have some meaningful ones that give the board true insight.
Richard, open banking. So obviously led strongly by Treasury and the ACCC at the moment in creation. Where to for ASIC in terms of open banking? Is it a sort of watch and act, let it get up and running and then come in later, or are you thinking proactively of what that environment looks like?
We have been, I suppose the work we've been doing to date has been focused on assisting Treasury and the ACCC and the OAIC with the establishment of the regime. It's something where we are quite excited about the potential that exists for helping consumers make better decisions about the kinds of products and services that they acquire. I suppose it's positive to, when you look at the rules that are in place and some of the examples that we've seen around, methods of, gathering or requesting consents that, are really quite different from sort of potentially some things that have been out there in the market for some time. It's something that we're going to watch quite closely, particularly the kinds of tools that do develop and the uses that those are put to. It's sort of, the regime isn't ours to administer, but we can see a lot of benefit that could come from it. So we're watching very closely.
Okay. Deborah, BEAR. So we spoke about how it's sort of almost running around the world and getting adopted everywhere. And APRA's now announced the end-to-end product review regime. So can you just see BEAR continually going further in organisations and through supply chains? Do you think we're at the start of that process?
I think BEAR and the regime itself should stay and remain at a senior level because it becomes just too difficult to manage it. But that said, what we're seeing with our clients is that the senior accountable persons under that regime, it's got a positive flow-on effect because they're now turning around, so looking over the shoulder. Where's my chief risk officer? Where's my chief compliance officer? I need to now understand the landscape of all these things I'm on the hook for. And I may never have really thought about that before, and certainly not from a product life cycle perspective, because that's not how we set up. So I think that's really positive. So the flow-on will be in that sense that I think foundationally organisations will improve their risk and compliance information flows and understanding and awareness of how are we managing our risks and our obligations, and that should flow back through to the accountable persons who should be able to clearly articulate how that's looked after and keeping their eye on that. But I don't think it should flow below, the very senior executive level, because it would just, as I said, become quite unworkable practice.
Now I'm going to make this the last one, Richard, it's for you. Get ready. And those that aren't, that I haven't got to, there's a few others, we'll make sure that they get answered through the post-meeting process. But Richard, APRA, we obviously saw their action against IOOF, wasn't successful. There was some subjective and technical things in that. Is that causing ASIC to think through the rest of its forward-looking agenda in terms of actions, or is it just steady as she goes?
They don't have Dan Crennan.
No, they don't. It is something that sort of we have taken on board, and that's fed into what we're doing in response to the Royal Commission. And I suppose similarly, any time a court case is unsuccessful, there are some things that you can learn from that. And we've had Tim probably wouldn't like me to sit up here and say this, but we have lost a couple of cases this year. And
Sorry, we're not broadcasting this to the web.
But there are things, and in some instances, what we have done is clarified the law, and then there's kind of scope for the powers that be to consider whether those settings are appropriate. And in some cases, it's perhaps a little bit more murky than that. But we have sought to learn from the action that APRA has taken, and we've got a range. The Royal Commission has referred a range of misconduct to us, and we're kind of considering what we do about all of those matters. And so developments like that are, front of mind as we try to prioritise and work out the way forward on those.
Good answer, by the way. You notice I didn't go to the ASIC one, so that was a free kick. Ladies and gentlemen, thank you to Richard and Deborah. Please give me a round of applause to them, and I'll hand you back to Adam. Thank you.